Welcome, everyone. My name is Dwight Slough, and I want to thank you for attending this educational seminar about Social Security entitled The 10 Things to Know About Social Security. Let me give you a little bit of background on myself. I started my business, DHS Financial Services, in 2001. And for the last 23 years, I've been doing financial services, which consists of tax preparation, investments, and insurance. So that's a little bit about me. Let's go ahead and start to look at some of these slides as it relates to our topic tonight, which is 10 things to know about Social Security. Social Security is an essential piece of the retirement income pie and plays a vital role in Americans' retirement thoughts and their budgets that they have. It is the most common source of income for retired Americans and is a significant asset that generates guaranteed inflation-adjusted income every single month that's going to be able to provide you with a base level of retirement income. So I'm hopeful that this time that we spend together today is going to benefit you and help you to understand a little bit more about Social Security. This is the legalese that we put up here. The presenter, which is myself, is no way employed by, or affiliated with, or endorsed by the Social Security Administration or any other government agency. All examples are hypothetical and for illustrative purposes only. Actual results will vary. No part of this presentation is intended to make an offer of sale or purchase of any specific security or insurance product. The information that we're covering in this webinar represents our current understanding of Social Security in general and should not be considered legal or tax advice by consumers. And again, details of Social Security program are subject to change at any time. So now that we've got the legalese out of the way, let's take a look at this continuum that we have here that's labeled key retirement ages and decisions. And so we see in the first little gray box up to the upper left, it says, when should I retire? Should I start receiving Social Security income as soon as possible, which is age 62, or should I sign up for Medicare? In terms of when should I sign up for Medicare? When should I buy long-term care insurance? So they start on this continuum and they give you some information as it relates to if you're under age 58, they tell us that it's never too early to start planning for retirement. The earlier that we start planning, the more that we're going to be prepared when that retirement time comes. And so, again, one of the key words that I'm going to be stressing as I go through this webinar is the concept or the word planning. So if you start early enough, then you would have more than enough time to make adjustments if the things that we have tried to put in place in terms of some of the strategies don't work out as we had intended them, then we don't have to be pressed for time. We have some time for those to be able to come to fruition. And so they just continue on through here. Age 62 is when everyone can start taking Social Security. But if you do it at that time, you're going to do it at a reduced amount. And again, it can be a significant amount over the lifetime of receiving these benefits. Then you see at age 65 is when some people, depending upon when they were born, can take their retirement and take their Social Security, if you will. If you do that, you can actually apply at 64 and 9 months, and it will begin when you reach age 65. So if you just put your eyes down on the lower right-hand corner and you see the red box, it's there. Full retirement age depends on when you were born. And so they give us different birth years, and then they give us when the full retirement age would apply to us. Again, most people that are between 1943 and 1954, somewhere along in there, you're looking at age 66. For the people that are 1960 or later, such as myself, it's age 67. So again, depending upon when you were born, sort of decides for you as to when you can start looking at taking these Social Security benefits. As we indicated, 10 things to know about Social Security, we've got 10 questions that we're going to address in this webinar. The first one is, where does Social Security fit into my retirement? Secondly, will it be there for me in the future? So we're going to share with you some statistics and some dates as to the viability of Social Security going forward. Number 3, how are my workers' benefits calculated? We will address that. Number 4, when can I start receiving benefits? Number 5, and this is the more common one that we receive, is what is the best age to claim? Number 6, what about continued employment and Part B Medicare premium? And so we're going to have some thoughts on that as well. Number 7, what are the 3 types of spousal benefits? Number 8, what if I'm in a non-covered pension? And we're going to explain to you what that means. And number 9, how are my Social Security benefits taxed? And then finally, number 10, how do I file for my benefits? There's 3 different ways that you can do that. And we will note those when we get towards that slide. So where does Social Security fit in my retirement? We see a pie chart here. The deeper blue suggests that's going to be your Social Security. Then you have other sources of income, such as an employer pension, a 401k plan, personal savings, earned income, annuities, and cash value life insurance. So again, part of what we try to develop for our clients is the strategies that would look at these other sources of income to see if we can go past the full retirement age in terms of when we're going to decide to access our Social Security benefits. And 2 of the ones there in terms of the sources of incomes that are typically overlooked or haven't been really, I think, part of people's strategies in the past is annuities and then the cash value life insurance. So again, with annuities, it's a contract between you and a life insurance company. You can select how you want to receive that income. It's usually over the lifetime of the person that has the policy. So it's something that you can't outlive. So as long as you're alive, you can get an income stream from an annuity. And so again, that's something you might want to think about. Cash value life insurance is the one that I see that I don't believe is being used as effectively as it can be. And again, when we sit down and talk with you about Social Security and retirement and those types of things, because they all are intertwined, I will bring up some types of strategies that will help you utilize that so that you can delay doing your Social Security as well as perhaps your retirement money, and be able to take money out of that life insurance, that cash value life insurance policy, tax-free. So we will address that when we have our one-on-one sessions. So where does Social Security fit when we look at these types of situations? So when we look at this, we see that as it relates to Social Security, we've noted before it's just one piece of our retirement income pie, but over time, these benefits add up. If someone were to retire today at the full retirement age with an average salary of $75,000 per year, that monthly benefit that you see there in the blue, the $2,168, is a significant amount, because over the course of the year, this would exceed $26,000, as they noted the gray box, 26,016. And if they live to age 90, the lifetime value of their Social Security benefits would be $841,593. So the amount of income a retiree can receive over their lifetime, as you can note there, is very substantial, and would be even more if you're looking at a married couple. So again, these are things that you're almost close to that lifetime value, almost close to $1 million. And so when you sit down and you start thinking about when do you want to take it, and those types of questions come into your mind, you can leave a lot of money on the table. And that's one of the things that we're trying to prevent when we sit down with you, is to help you to understand what your options are. And if age 62 is when you should take it and you understand the full ramifications, that's fine. But if you want to wait to full retirement age and then take it, we can show you what those numbers look like as well. But the ultimate goal, I think, for most people should be taking it at age 70. And so we're going to explain to you why you should try to shoot for age 70. The most obvious is the lifetime value is going to be higher, which is, I think, what everybody wants to have. So why is Social Security a unique asset? That's one of the things that we have 6 boxes there that will help to sort of show us why it is a unique asset. The upper left-hand, we see lifelong income. That is, lifetime income protects against the risk of outliving your money. So it's very similar in terms of the lifetime income, like what I was referring to with the annuity. Inflation protection, there are cost of living increases that help the senior with these benefits in terms of keeping pace with inflation. There's a cost of living allowance that they look at each year to determine if they need to adjust that. If they do, then your benefits will be adjusted as well. Number 3 thing they have there is tax favored. Benefits receive preferential tax treatment compared to other sources of retirement income, and we will talk to you about that. The 4th thing is market volatility. Benefits are not impacted by the stock market volatility. And one of the things that I'm doing this in August of 2019, and in the weeks and days and so forth, in the weeks and days that have been leading up to the time period we're in now, the stock market has been very volatile. And so with Social Security, that's not something that you have to worry about. So that's a plus for the person that has their Social Security benefits they're receiving. Spousal benefits. Benefits may extend to a current, to a former, or to a surviving spouse. And so again, the previous slide, when we're looking at that lifetime benefit, we want to make sure that we're optimizing that, because if one of the spouses is deceased, then we want to make sure that the other spouse that's still alive doesn't have a reduction in their standard of living. And then the final one is government promise. The benefits are backed by the promise from the United States government. So let me give you a little bit of history of Social Security. It was, as the slide indicates, signed into law by President Roosevelt on August 14th, 1935. Payroll taxes were collected for the first time in January of 1937. And at the time this was introduced back in August of 1935, the life expectancy was 63. So that has certainly changed quite a bit, because now people are living into their 80s and 90s. And occasionally we have people that are living into their age 100 and above that. The first retirement benefit of $22.54 was issued to Ida Mae Fuller of Ludlow, Vermont on January 31st, 1940. That's the equivalent of $403 in today's dollars. And Miss Fuller lived to the age of 100 and passed away in 1975. She was paid $24.75 of that in terms of what she paid in, and she received $22,888.92 of total benefits during her lifetime. So for Miss Fuller, paying $24.74 in, or $24.75 in, what's a penny between friends, and receiving $22,888.92 in benefits, it paid off quite handsomely for her. Social Security today is the most common source of income for retired Americans and is one of the largest government programs in the world. So when we think about it as being the most common source of income for retired Americans, it's something that, we would think we want to get it right for our client or for the person that's going to be taking these benefits. Because if you're living on a fixed income and you're just waiting on the cost of living to increase and have the government give you whatever percent that they would, that may not be optimal for you. An estimated 175 million workers are covered by Social Security. Nearly 50 million Americans receive retired workers or survivor benefits. Again, the average monthly retirement benefit is $1,413, and the source from that is the Social Security fact sheet. Will it be there in the future? For many years, the trust operated at a surplus. But today, due to the changing demographics, there are concerns about future solvency and projected shortfalls, because we are entering the time when a lot of the baby boomers are coming of age where they can start thinking about Social Security. So that's part of the demographics. The other part would be the fact that you don't have as many younger workers that are in the workforce that has been there traditionally in the past. So there's not as many people that would be available to pay into Social Security. Government data indicates that Social Security will be able to pay full benefits through the year 2034, assuming no changes are made. After 2034, the anticipated revenue would cover 75% of the future benefits. So again, this information is based on the Center on Budget and Policy Priorities. There are three basic proposals that people have been floating around as it relates to possibly trying to extend Social Security beyond 2034, where we don't have that reduction of down to 75% of those benefits. The first one is to increase the wage base. And so, again, this is something that periodically it changes in terms of if you're working, that you're going to be paying a little bit more. As a matter of fact, there was an increase to the Social Security wage base that was a 7% increase in 2017. So again, they're looking at what people are making, trying to extend that a little bit more so that, again, they can collect more of the Social Security tax. The second one is to increase the payroll tax that people are having withheld from their wages. And then the third one is to increase the full retirement age. So the question would become, will they go back and maybe do some grandfathering or adjusting the rates in terms of the number of people and their different birth dates and so forth? So those are the three basic proposals that they have. There are other proposals that include a decrease in benefits or means testing for benefits. So two other potential ideas that they're looking at as it relates to how we can extend the life, if you will, of Social Security and continue to make sure we keep those commitments to seniors. So some people say, well, how do I determine what I'm going to get when I decide to take this Social Security benefit? Well, there are two main factors. There's your earnings history, and that is based upon the highest 35 years of earnings, and then the age when the benefits began. So those would be your two main factors to determine what your primary insurance amount is going to be. As far as eligibility, there are 40 credits of work that you need. Normally, you'll get 4 credits a year. So in 10 years of having a work history, you would satisfy that eligibility requirement. And then primary insurance amount, or the PIA, the average monthly earnings that are indexed for inflation using the highest 35 years of earnings. So people are getting Social Security statements. And if you're under age 60, it indicates here it's online only. There are no paper statements. So what you're going to need to do is go to ssa.gov and go ahead and sign up, enroll, if you will, not in the benefits, but to start receiving these statements so that you can look at them. And on the left-hand part of the screen, you can see just a little snapshot of what your Social Security statement will look like. Again, at the very top, it says your payment would be about $1,915 a month at full retirement age. And then it has some other types of things as it relates to disability and survivor benefits and so forth inside. What I encourage my clients to do is to provide me, if it's a husband and wife, to provide me with both of their Social Security statements, as well as the previous 2 years of their tax return, as well as what they have in terms of investments, because all of these go hand in glove. Because what we're trying to do is to say, again, how can we get you to the age 70 without having to take these benefits? Or if we do, what's the best strategy for doing that? So again, I would encourage people to get those statements, print them out, and make sure that you understand what they are. One of the things that I do as part of my service is to sit down with clients and say, okay, here's what we're looking at. How comfortable do you feel with that? We have software that can do stress tests, which again, to me, in common man's language, is it's what if. So what if we do this? How will it impact your Social Security and so forth? If you're over age 60, it notes here that you're not receiving benefits and you haven't signed up online. You may still be able to get some type of statement. So let's discuss full retirement age. Again, that little birthday cake there with the candles and the sprinkles and so forth says 67 is the new 65. So depending upon what your birth year is, and you can see beginning in 1943 to 1954, 66 would be the full retirement age if you were born during those times. And then it just goes down there for each year that you get up until the birth year 1959, it increases by 2 months. Then if you're 1960, born in 1960 and later, then the full retirement age is going to be 67. So again, these are things that we need to take in consideration, because full retirement age, you get 100% of what your primary insurance amount is. So that's the importance of looking at that. So when can you claim? Well, you can claim early. If at age 62, you say, I want my Social Security benefits, then you can file and start receiving them. Again, one of the major drawbacks is that you're going to have up to a 25% reduction in those benefits, and that continues over your lifetime. So again, if you start planning early enough, you can have strategies in place that will be able to help you to say, you know what, maybe I can wait a little bit longer to my full retirement age at least, so I don't have this reduction that I have to be concerned with. Again, you can do the full retirement age, get your primary insurance amount. In this case, we're looking at someone that's age 66, or you can delay it and collect it or start it at age 70. The benefit of doing that is you get an 8% increase each year. So if you're looking in this example at 4 years, you got a 32% additional amount. So instead of getting 100% at age 66, your full retirement age, what you're going to be getting is 132%. Big difference. And so again, it doesn't make any sense to go to age 71 or 72 and say, oh, okay, I'll go ahead and start my benefits then, because the 8% credits that you're receiving during that time from your full retirement age to age 70, it stops at age 70. So that's not going to be your benefit to try to, wait till after age 70 and try to see if you can get another 8%. Won't work. So we see a little chart here. It says the advantage of waiting. So again, using the example that we had, excuse me, someone that is 62 and takes their benefits early, they're going to get $1,500. So that's a 25% reduction. So at age 62, they're going to get $1,500 a month. If they waited to age 66, by waiting those 4 years, it's going to provide them an additional $500 more a month for life. So they go from $1,500 at age 62 to $2,000 at age 66. If they can wait to age 70, that's waiting 8 years more, then it provides $1,140 more a month for life. So instead of having $1,500 at age 62, they will get at age 70 $2,640. So that's a 76% increase if you waited those 8 years to start your benefits at age 70. So again, there's a lot of money that you don't want to leave on the table. So let's make sure that we do that properly and decide what's going to work best for us. Life expectancy, that's another variable that comes into play. So if you don't have a long life expectancy, perhaps you have been diagnosed, unfortunately, with some type of a cancer or some type of disease or illness that's going to shorten your life expectancy, then perhaps you might want to take it at 62 so that you can get the money and enjoy it while you can. But what they're showing here, that if you are a male or a female, if you're a male first and you're age 65 years old at this time, then you have a 50% chance of living to age 87. If you are a female, age 65, you have a 50% chance of living to age 89. And then likewise, male 65, you have a 25% chance of living to age 93. Female age 65, you have a 96%, you have a 25% chance of living to age 96. And one of the things that they note here in the slide is for married couples, there's a 50% chance one spouse will live to age 93. So it goes back to what I was saying earlier and making sure that we're planning properly, because if you have a spouse that could possibly live to age 93 and at least a 50% of the chance of that happening, wouldn't it be sad and unfortunate if that spouse had to reduce their standard of living because they made wrong decisions as it relates to Social Security, and so they're getting less benefits than what they should have had? So again, very important, life expectancy. We need to pay attention to that when we sit down and have a discussion. So they give you a chart here that says total benefits received by age. And again, they break it down. Again, age 62, 66, and age 70, the $1,500 for age 62, age 66 is at $2,000 a month, and the age 70 is at $2,640 a month. So at age 62, if you looked at living out to age 80, you would have received $402,954 in benefits. If you took your full retirement age at age 66 in this example, and you got $2,000 a month, at age 85, you would have $574,704 in benefits received. And then at age 70, the 2,640, the highest that we could take, that 132% more in benefits. By age 90, that would be $809,255. So basically what we're seeing here in terms of total benefits received, it makes a difference in terms of, in some cases, hundreds of thousands of dollars if you do the wrong claiming strategy and you take it at the wrong time. So the question that most people have is, what is the best age to claim? So one of the things that we note here is there is no single best age to claim. It is everyone's situation being unique. And so therefore, when you sit down and you start looking at when you should take this, there are different types of circumstances that come into play. So what may work for you may not work for someone else. Lifetime benefit amounts depend on three primary factors. Number one, your earnings history. And again, they're taking the highest 35 years that you have. Secondly is life expectancy. And we just briefly discussed that in terms of how long we expect that you would be, live and so forth. And then the third is the age you elect. So those are some of the factors that you would look at in terms of your primary factors. But there are other factors that we would need to include, such as your health. And again, depending upon how healthy you are, when you get close to making your decision, may change when you want to take your Social Security benefits and have them started. Second is marital status. And again, we go back to the thinking of, we want to make sure that the surviving spouse has the same standard of living and doesn't see any difference in that if the other spouse has passed. Again, the desire to continue working. And we're going to look at that here in the next couple of slides in terms of, if you work up until your retirement age, do you see a reduction in your benefits? What happens when you get your retirement age? And then what happens when you pass your retirement age in terms of, are there any reductions to your benefits? So we want to look at that as well as finally access to other income sources if you decide to delay your Social Security. And so that goes back again to what we were referring to when we said, okay, you have your pension plans, your 401k, you may have an IRA, you may have a savings account, you may have an annuity, you may have cash value life insurance. Those are the different sources that we're looking at to say, what does it make sense in terms of how can we set this up that's going to work best for us? So what we were just saying, what if I continue to work? And I have had clients that said, I want to continue to work as long as my health holds out. And so what happens to my benefits if I do that? Well, earned income before your full retirement age is subject to the earnings test. That is, there's a benefit reduction based on your annual earnings. But the good news, it's not permanent. So if you earn more than $17,640, and that's for tax year 2019, your Social Security will deduct $1 from your benefits for each $2 that you earn over the threshold. In the year that you reach full retirement age, you can earn up to $46,920. That is, again, in 2019, without having a reduction in your benefits. And then there is no loss of benefits after your full retirement age, regardless of income. Okay? So these are the things in terms of earnings tests and those types of things that you need to be aware of. And if you're planning on working longer, then you need to sit down and let's take a look at this and see what makes sense for you. Medicare Part B, monthly premium. So we're going to look at, this was based on yearly income in 2017 and what you would pay here in 2019. So what they do is they look back 2 years generally on your tax return. And so let's look at the middle column, because a lot of the people that I deal with are married filing joint. So if you made $170,000 or below, you're paying $135.50, or you can expect to pay $135.50 for your Medicare Part B premium. If you made more than that, you can see on this slide that it continues to increase to where if you made $750,000 or more, you would pay a Medicare Part B premium of $460.50. So it's capped. It goes from $135.50 on the lower end all the way up to $460.50 on the higher end. Now, they say here in the note that for 2019, the standard Part B premium amount is $135.50, which is what we indicated, or as in they noted in parenthesis here, higher depending on your income. Premiums are usually deducted from your Social Security benefit payment, which is it's fine to do that because, again, you're going to be getting your net Social Security put into your checking account. The only thing that I would say here is two things. One, you need to do some planning again, because I had a gentleman that had a business, sold the business, and then within 2 years was doing Social Security. They looked back those 2 years and he got stuck paying a higher Medicare Part B. So they look at it every year. So it's not something that, again, you're stuck with. So again, you need to plan. If you got a business and you're going to be selling that, how would that impact your Social Security and in this case, your Medicare Part B? And then the second thing that I would encourage people, and this is just an aside, if you have your Part D, your prescription drug plan, I would never have it taken out of my Social Security. The reason being is you're aware that every year you can, during open enrollment, you can change your prescription drug plan and make it effective for the first of the next year. But if you have that with your Social Security and it's being taken out, it can take at a minimum up to 90 days. At least that's been my experience in the past. When this first came into being under the Bush administration, the recommendation to us as brokers were to, hey, take it out of Social Security. But 90 days is way too long for a senior, especially on fixed income, to have to wait to get their prescription drug premium halted and the new one in place. So I would not do that. It's just an FYI as it relates to Medicare Part B, and in this case, the Part D, which is your prescription. So here's some claiming strategy. What if you want to take it before your full retirement age? You can begin at age 62 for the worker and the spouse, and it's age 60 if you happen to be a survivor, someone has passed away. The benefits are reduced, so you have to keep that in mind. And continued employment is subject to the earnings test limitations that we talked about. It applies to the worker, the spouse, and the survivor benefits. So again, keep these things in mind. The full retirement age, the worker receives his full retirement benefits, which is his primary insurance amount. There is earnings test limitations that no longer apply if you have continued employment. So again, we want to make sure that we know what the cap is on that. And then after full retirement age, worker benefits increase 8% each year you delay past the full retirement age. Increase does not apply to spousal or survivor benefits. And again, as noted earlier, the increases end at age 70. So there is no further benefit due to age 71 or 72 and so forth to decide to start your Social Security benefits. So if you're single, pretty straightforward. Two basic options: claim now or claim later. But there are some things that we need to address if a person is single to make sure that we're getting the best for them in terms of making a claim. There are three types of spousal benefits. There is the spousal, there is the divorced, and then there is the survivor. Married individuals, it talks about being gender neutral. You can claim on your own, or you can claim on the spouse's earning record. Again, here, spousal benefits equal 50% of the worker's spouse's primary insurance amount. If your own retirement benefit is lower than the spousal benefits, Social Security will pay you the higher benefit. Sometimes you may have ladies that have been staying at home, taking care of their children, have been out of the workforce for a period of time, and so they haven't had those earnings years that they could put in there into those top 35 years to figure out and have a higher primary insurance amount. So again, if you're married, you can access up to 50% of your working spouse's primary insurance amount. But with everything, there are rules. And so again, we're staying on the subject of spousal benefits. You have to be 62 or older. You have to be married for at least 1 year. And the worker must file for benefits before the spousal benefit is available. So excuse me, if you are the spouse and the other spouse is still working and hasn't filed, you can't do it. So you have to have them file. You have to be married for at least 1 year, and you have to be 62 or older. The benefits, again, can range anywhere from 32.5% up to 50% of the working spouse's primary insurance amount, depending on the spouse's claiming age. So again, these benefits are based on when the spouse claims, not the worker, and does not affect the working spouse's benefit. It is permanently reduced if you take it before your full retirement age, and you do not increase if you delayed past the full retirement age. So we have a case study here between a married couple, Jackie, who's not eligible for the retirement benefits based on her own record, and Steve, whose primary insurance amount at full retirement age is $2,400. Therefore, Jackie is entitled to receive $1,200, which is the 50% of Steve's primary insurance amount, as a spousal benefit when Steve files for his own worker's benefit. The total household income from Social Security would be $43,200 per year. So you're taking $2,400 of Steve's and $1,200 of Jackie's, which is $3,600 times 12 months, gives us the $43,200 per year. So we look at this and we say, okay, what if we do this before full retirement age? If Jackie claims before her full retirement age, her spousal benefits will be permanently reduced. For instance, if she applied for spousal benefits at age 62, her benefit will be reduced to 35% of Steve's primary insurance amount. Therefore, her spousal benefit would be $840 instead of the $1,200. So that's his $2,400 times 35%. At full retirement age, if she decides to file then, her spousal benefits would be the $1,200, which is 50% of Steve's primary insurance amount. And then after full retirement age, if Jackie waited until after her full retirement age to claim her spousal benefits, her spousal benefit amount is still going to be $1,200. The benefit amount does not increase if it's delayed past the full retirement age. So we want to keep that in mind. How about divorced people? Well, here's your eligibility for that. Both spouses are 62 or older. Marriage lasted at least 10 years. They have been divorced for 2 years or longer. The claiming ex-spouse is unmarried. And then finally, the former spouse can be remarried and doesn't have to file for benefits. So a little bit different eligibility as it relates to if you're divorced. Some of the benefits, you can collect spousal or survivor benefits based on your ex-spouse's work record. It's no impact on the former spouse's benefit. It's not subject to the family maximum, which is the dollar amount that some of these benefits could be subject to, but not here. But it is subject to the earnings test if you're still working. So again, some of these things we would go into more depth when we're dealing with clients to, again, show them these things and expand on them and make sure that they have a good understanding of what their decisions can be and what will happen if they do this decision versus another decision. Survivor benefits at the death of the first spouse. The surviving spouse receives the highest of his or her own benefit or the benefit of the deceased, or 82.5% of the full retirement age benefit of the deceased. The lesser benefit disappears. Again, on the survivor benefits, the eligibility, it's available to widows, widowers, and surviving ex-spouses. Must have been married at least 9 months, except in the case of an accident. Must be 60 or older, and currently widowed or remarried after age 60. So again, whether it's spousal, whether it's divorced, or whether it's survival, there's different eligibility requirements. And so you need to make sure that you're familiar with, okay, where do I fall? What are my eligibility requirements? What are my benefits? Survivor benefits, reduced benefits can be taken at age 60, age 50 if the person is disabled. It is subject to the earnings test if you're still working. And finally, alternative claiming strategies may be available if you're entitled to both worker and survivor benefits. Again, this is something we would sit down and talk about. Claiming considerations. And again, One of the things that I've been trying to stress as we go through these slides and talk about Social Security is you have to plan. Planning is very important. And so they sort of highlight that here when they say 100,000 or more difference in lifetime household income could be, affected or could come into play if you haven't planned properly. And so one of the things you want to do is make sure you're sitting down with someone that has a good understanding of these different claiming strategies, the eligibility, when you can do this, when you can't do that, and make sure that, like I say, that you're on the same page and that you can accept and understand what you're going to be doing in terms of your decision. But proper planning is the key to everything. So here's some claiming considerations. As a general rule, do not claim benefits early if you plan to keep working. Spousal benefits are up to 50% of a worker's primary insurance amount, and survivor benefits are up to 100% of the covered spouse's benefit. Additionally, spouses who do not qualify for benefits of their own must wait for the worker spouse to file before they can collect. And then finally, married couples should plan in terms of joint life expectancy and coordinate their claiming strategies to maximize their benefits. So again, when I sit down with the client, I say to them, I want both Social Security statements, I want the last 2 years' tax returns, and I want to look at retirement, what your sources of retirement would be. In most instances, it is advantageous for the higher earning spouse to delay their benefits as long as possible, ideally to age 70. And that's simply because you give the opportunity to add the extra 8% credit each year until you get to age 70. And the higher the retirement benefit would be, then the higher amount that 8% would be applied to. This maximizes both their retirement benefit and the survivor benefit for the widow or widower. Okay. So again, it's important if you have a spouse to make sure that you are doing the right strategy to ensure that he or she can still live comfortably if you predecease them. If income is needed, it is often beneficial to trigger the benefits of the lower earning spouse early if they're no longer working and at the full retirement age if still working. Surviving spouses can switch between benefits. They could collect their survivor benefit first and then switch to their own benefit that would grow by 8% until age 70. Or they could collect their own reduced benefit first and then switch to the maximum survivor benefits at full retirement age. Even if couples maximize their benefits, household income may still decline for the surviving spouse. And so this is where they note life insurance or an annuity with a survivor benefit can provide valuable protection and help to replace lost income. And so again, at the very outset, I indicated annuities and cash value life insurance, I believe, have strategies that are not being properly utilized for people. And again, a lot of money is being left on the table unnecessarily. What about if you decide you want to change your election? You've gotten it and you said, well, maybe I've met with someone and they said this may not have been what you should have done. Here's some of the things as it relates to that. If you're receiving and you change your mind, you may be able to withdraw your Social Security claim and reapply at a future date. But there's some things that you have to pay attention to. First of all, you cannot withdraw your application after 12 months. So you have 1 year to decide, I want to stop this and I want to reapply at a later time. You are limited to one withdrawal per lifetime. Next, you must repay all of the benefits that you collected during that time. So if you're 8, 9, 10 months in, you need to make sure that you would be able to pay those benefits back if you elect to stop and start at another time. That's usually the one that sort of catches everyone because most of the time the money's spent. But if you can do that and you can pay it back, then you can file a form SSA-521 and they will be able to stop it for you. And like I say, you pay them back the money and then you can restart it again at another time. So what if you have worked for the government and no Social Security benefits were taken out? So we have here non-covered public pensions. One is the government pension offset, which applies to workers applying for spousal or survivor benefits who are also receiving a pension from a non-covered government job where Social Security benefits were not withheld. Here, the government pension offset reduces the amount of your spousal or survivor Social Security benefits by 2/3 of the amount of your government pension. So again, we need to make sure we've got those sources of income in place that can help us with this. The other one is the windfall elimination provision, which is a recalculation of your Social Security benefit if you also have a pension from a non-covered work where no Social Security taxes were paid. Pension payments may reduce Social Security benefits by up to 50% to a maximum of $447.50. Now, the good news is that little paragraph below, it says the impact of the windfall elimination provision starts to decrease if you have more than 20 years of service at a job where you paid Social Security into it. You paid their Social Security taxes. So again, just something to keep in mind if you haven't paid had any withholdings of Social Security taxes and you were in these non-covered public pensions, then we need to look at addressing that. So look at Social Security and how it's taxed. It's under what we call provisional income. So we take 1/2 of Social Security, then we add our wages, any pensions that we have, any investments that we have, any interest that we have, as well as qualified plans and IRA withdrawals. And then we add non-taxable interest back in as well, those municipal bonds that you've been living off of. All of this is brought back in to give us the provisional income number. Now, one of the things that I have had clients do since I do taxes as part of my practice, if you have some minimum required distributions from IRAs and retirement accounts and so forth, you can do a qualified charitable deduction where that money, the required minimum distributions that you're taking out, if you put it into that, give it to the qualified charitable, then you can take it as a deduction. It's not included in your income. So where that comes into play is on this next slide here, where we look at provisional income and look in the middle again for the married filers. If you have less than $32,000, when you add all of those up, then 0% of your benefit is subject to taxation. However, most people will fall into the next two categories. If it's $32,000 to $44,000 for married filing joint, then up to 50% of your benefit is subject to being taxed. If it's more than $44,000, then up to 85% of your Social Security benefit could be taxed. So again, depending upon where you fall with this, and again, if you've properly planned and you're meeting with your tax advisor, tax person that's doing this in terms of preparing your taxes, they should be able to assist you to try to minimize the amount of taxation of Social Security benefits. So how do I file for benefits? There are three ways. You can do the 800 number via phone. And to that, I say good luck, excuse me, because there are probably going to be some wait times. So you can do it at the 800 number. You can do it online at ssa.gov. And again, if you're not really good at hunting and pecking, then for a small fee, we can assist you with that. And then you can do it in person at your local Social Security office. You would probably need to make an appointment with them so that they could set up a time to sit down with you. So again, those are three different ways that you can file for your benefits. So let's do a recap. Those 10 questions that we asked that people have as it relates to 10 things to know about Social Security, we started off by saying, where does Social Security fit into my retirement? We did the little pie chart. We noted that Social Security usually is a larger part of a person's retirement. And then we also noted the other sources of income from a pension plan, 401k, savings, annuities, cash value life insurance, and such. Secondly, we said, where will it be for me in the future? Or will it be there for me in the future? And we noted that at least to year 2034, we anticipate without any changes that you should be able to get your benefits. After that year, then we look for you receiving about 75% as opposed to 100% prior to that. How are my worker benefits calculated? Again, we look at it in terms of your highest earning years that you have as part of that equation. When can I start receiving benefits? You can start as early as age 62, but normally to get 100%, you have to do your full retirement age, or to age 70, you'll get 132% of what you normally would get. And then what's the best age to claim? Question number 5, we said there is no best age. It varies depending on each person's unique situation. And then number 6, we said, what if I continue to work? We noted in terms of if it's before full retirement age, there's a certain dollar amount that for, they'll take $1 for every $2 that you earn. That you get to full retirement age, then again, they cap it at a certain dollar amount. It changes. So I don't, what was in the slide was 46,000, I think 920. But again, that changes. So I don't lock it in between my two ears, because if it changes, it changes. And I don't want to keep, old numbers there. And then after full retirement age, you can make as much as you want and you don't have any type of reduction. What are the 3 types of spousal benefits? We talked about spousal. We talked about spousal, death benefits or survivor benefits, if you will, and divorced. Those were the things we were looking at. What if I'm in a non-covered pension? We talked about that in terms of the reduction that you would see. How are my Social Security benefits taxed? We just showed you the provisional income and how that was put together. And then how do I file for benefits? We told you the 3 ways to do that. You can call them, you can go online, or you can make an appointment at your local Social Security office. So let's make some concluding remarks and we're finished, okay? Social Security is an important piece of the retirement income puzzle. And as such, you need to sit down and get as much information and, work with someone who's competent and that can help you digest that information and put it into a plan that you can work, and that if changes need to be made, that, you can do that as well. Understanding your options and making informed decisions can help to maximize your benefits. And again, I would be happy to work with you to assess your personal situation. So we've sort of run a little long. And so questions that you may have, you can submit them to me. You can give me a call at 540-438-0288. And I'd be more than happy, and you'll see this on the next slide, more than happy to sit down with you and talk to you one-on-one in my office. Or you can, in terms of giving me that call at 540-438-0288, or you can email me, my last name, slough@hotmail.com. And again, when I look at these webinars, I look at them as 2 parts. The first part you just sat through. The second part, which I believe is the most important part, is the action part. Because if you're just collecting knowledge, if you're just collecting information and notes and you never sit down and you never act on them, you've really wasted your time. So again, the most important step, as I note here, is that you need to sit down with someone, because again, each person's unique. Each person has a different situation. And so the only way that you can actually, get what's best for you is to tailor your strategies towards what's peculiar about your situation. So again, I would urge you, don't put it off. Do it now. It's still fresh on your mind. And give me the call, send me the email, go to my website. You can see it there very faintly, dhsfinancialservices.com. Go there and you can decide to make an appointment with me. I'd be more than happy to sit down with you. Again, the things that I would need is I need your Social Security statement. I need to have your last 2 years tax returns. And I also need to have what you're doing retirement-wise. So again, I do really, truly appreciate the fact that you've taken the time to listen to the webinar and to view these slides. If there's anything that I can help you with in the future, I am always available to work with you. So just let me know what works best for you. And I also would encourage you that I will be sending on Facebook and other places, I'll be doing other webinars online. And so I would encourage you, when you see that, to sign up, and we'll go through some different things as well. Again, I do appreciate your time, and I wish you well for the rest of the evening. And so with that, I say thank you and goodbye.